Everyone. We want to welcome all of you today. We're going to hear the exciting about IRS troubles, which is an exciting topic and can or may make a lot of you nervous. And particularly, we're going to talk about international penalty issues and concerns in regards to having troubles with the IRS. My name is Jared Johnson. I will be one of the presenters today. I am a senior manager at Eide Bailey. I am part of the international tax team or in the National Tax Office of Eide Bailey. I specialize in working with individuals with cross-border issues, and so helping individuals file with any foreign assets, really, and helping them both timely and delinquent filings as well. And I've been with Eide Bailey now for about 5 years, and I've been doing this kind of level of work for about 13. Ben Peeler, he's also joined us today as a presenter. I'll let Ben introduce himself.
Right, so I'm the head of our tax controversy department here at Eide Bailey. I've been with Eide Bailey almost 6 years, but I was previously an IRS attorney and assisted in these matters. Basically, my role was reviewing and sort of going after some very willful violators of international penalties, but IRS attorneys take a role in reviewing the penalties and whether they should be asserted, so it becomes an important step in the audit. I'm a tax attorney and CPA by training, and I was with the IRS for 8 years. Before that, I was an attorney in private practice and came to Eide Bailey straight from the IRS. So I've been doing this for many years, working on 20 years now. So if we can go to the next slide, just to give you an idea of what we're going to cover. Jared, you got it?
Yeah, I'm.
We are the apparently mess up the most on these new Zoom ones.
Yeah.
Last year, Jared and I couldn't figure out how to get. Jared was presenting, no, he wasn't being heard for a while.
Yeah.
We'll try to keep from doing that, but these are the learning objectives. We're going to discuss the international informational reporting and IRS regulations. It's a maze of different forms and requirements, and the reasons behind each often are disconnected from the reality and implementation by the IRS. We'll review the forms and the best ways to mitigate risk, kind of what the audits entail and what you can do and arguments you can make, and then an overview and discussion of the current programs. And this is basically post OVDP, right, Jared? So kind of what we're seeing in the year past the close of that program.
Yep. Okay. There we go. So as you can see from this slide, there are here are many of the different U.S. international informational forms and returns which U.S. persons are required to file with the U.S. government. Many people wonder why the U.S. would require so many different international informational returns and information. The U.S. government requires these forms as a means to fight financial crimes such as money laundering and tax evasion, also to combat the support of terrorism. As a result of these purposes, really, you'll see very significant civil penalties and sometimes criminal penalties associated with failure to file these forms, which we'll go over in a little bit later. But really, the most common of these is obviously the very top one, the FinCEN Form 114, which is abbreviated FBARS. We'll talk about that in more detail in just a minute. Its sister form is filed, the FBAR is filed separately than the 1040 tax return or corporate returns. The 8938 is the sister form of the FBAR form, but it's filed with your actual tax returns with different thresholds as well. So then there's forms to report foreign trust reporting. There's also forms the IRS requires for reporting different filings for foreign ownership and foreign entities, such as partnerships, corporations, or disregarded entities. And then last of all, yeah, go ahead, Ben.
Can I ask you a question, Jared? So what does it mean, U.S. persons?
We'll go over that in just a bit, and in one of the future slides, we'll go over that in really fine detail of what it is. In summary, though, a U.S. person is a citizen, green card holder, or a tax resident of the U.S. And we'll focus on what a tax resident of the U.S. is, because that's something that can trip someone up unbeknownst. And even the other two tests can trip people up that they don't know. So anyway.
So all these forms we have listed here are the forms that U.S. persons may or may not be required to file, right?
Exactly. Mm-hmm.
But there are some others that foreign persons need to file, sometimes don't, right?
Sometimes, yes. They so a non-resident alien, if you're making yourself a non-resident alien be under using a treaty clause, you would still be required to file an FBAR and an 8938, and arguably some of these other forms. The rules and laws are very gray by the IRS, and they won't come out and say, yes, you do. But if you make yourself a non-resident by claiming a treaty position, then some of these forms, if not all of them, you could be required to file them. So very good question.
So lots of traps for the unwary, right?
Yes, very, very much so. Yep. So the other one, we won't really talk about it today, but there's not really a lot of penalties around it, but it's Form 8621, which is something a lot of people don't really know much about, but it's passive foreign investment companies or ownership in basically for individuals, it's ownership. Like if you have a mutual fund set up in the US, the way I describe it is if you had a Fidelity account in the US, you open up a Fidelity account in the US and it had mutual funds and they were foreign mutual funds, you wouldn't have a PFIC. But if you opened up a Fidelity brokerage account in the UK and it invested in foreign mutual funds, you do have a PFIC. And so there's lots of different tax and reporting issues that are around this. Your statute of limitations never expires if you don't file a PFIC. There's not the civil penalties that the other ones will get you, but the tax and the interest derived from some of these, especially as someone that's just unknown that they have a PFIC and all of a sudden they find out years later that they do, they could have a serious tax issue with them as well.
Probably one thing worth mentioning is the law defining some of the PFICs, right, changed recently. Years ago. Affects captive insurance companies that were formerly considered NCFCs, right, non-controlled foreign corporations.
Yep, and that's really who it was derived to get and capture. But the rules you explain, the rules that define what a PFIC is do capture mutual funds and like investment accounts, unfortunately, outside the U.S. So
more a discussion for another day.
Yes, exactly. Yeah, that could be an entirely different presentation. So, like I said, the most common of these foreign investments reporting, these foreign international information reporting, is the FBAR or foreign bank account reporting. I talk to people regarding reporting FBARs on a daily basis, and many questions come up during these discussions. And one of the main questions that's asked is, how many years has the FBAR reporting been around? And people are very surprised to hear when I tell them that its original origin, it basically originated with the Bank Secrecy Act of 1970. So it came out. But the large civil penalties that we talk about related to them actually began as part of the Jobs Creation Act of 2004. So some of the more common compliance changes around FBAR, and they're not like recent changes, but they're recent enough where obviously this FBAR reporting has been around for years, but within the last 2 or 3 years, there's been some actually probably around 5 to 10 years. A lot of these have changed, and trying to get people's mindsets changed with them. So I bring these up on a regular basis, but you're supposed to e-file. All FBARs are now required to be e-filed. You can't paper file them. And also the due dates of them have recently, and that have changed. And this is more recent, probably even within the last maybe 3 to 4 years. And that's the deadline used to be a June 30th deadline. Now it's an April 15th that follows the individual tax compliance calendar. You can extend it, but it's actually an automatic extension. So you actually have until October 15th of every year to file these forms.
That's new too, right? There wasn't an extension for it.
Yeah. And a lot of people ask me, like, can you file an extension for me? You don't need to. It's just automatic. And so but you can't extend it past October 15th, or else we're dealing with penalty issues and these other programs that we're going to talk about. So the main thing, that the filing threshold for the FBAR is $10,000 in aggregate. The way I like to explain that is if you have 2 foreign bank accounts, and each of them have $5,000 in them, you have an FBAR filing obligation, and you have to disclose both of those bank accounts. So that's kind of what the aggregate means, and obviously it's within a calendar year. You file and report the maximum balance in an account over a calendar year. So
one more quick question, mention about extensions. You can't, just because they changed that for the FBARs and made it more taxpayer friendly, you can't assume every form, you can't assume that your extension with your form extends that form, correct? Not the FinCEN 14.
Yes. So not all extensions are automatic like that, especially like if you're dealing with an individual 1040. I think this is where you're going, Ben. But if it's like an individual 1040 account, you have to file an extension form by April 15th. It's not an automatic extension, whereas the FBAR it is, and you don't have to file a form. And again, the FBAR and all these other forms we talk about, a lot of them are informational in nature, and so there's no tax due on them. There have been recent changes with tax reform with the 5471s and some of these things where income is now flowing through from these foreign entities onto your personal returns. So it's still informational return, but it's also calculating income a lot of times now that are now flowing through returns. So the tax is actually calculated on the actual tax return, but the information flows through these international informational returns. So if that makes sense. And Ben, I hope I answered your question.
Yeah, that's something that always comes up, is whether or not an extension should have been filed.
Yeah.
Don't assume.
No. So this brings us to our first polling question. So number 1, the question is when was the FBAR reporting first implemented in the U.S.? And Amy, and the answers are there, or the different answers are there, and I'll let you guys give you about 30 seconds to respond. One thing I want to bring up though while we're waiting is that the world is becoming much smaller, meaning people are more global and companies are more global. And so I'm seeing more and more people that have ownership in foreign financial accounts or who own foreign assets. And so these issues, I don't think were as common 20, 30 years ago. But boy, they are becoming more and more common. There's more and more people with these types of issues. And anyway. So it looks like the results are in, and the majority answered with B, which is the FBAR reporting began with the Bank Secrecy Act of 1970, and that is correct. And so the penalties began in the civil penalties began in 2004. The implementation of the actual reporting began in 1970. So, all right.
Okay, the next big important part of all of this international penalties and reporting to me is the statute of limitations. Right, the statute of limitations is different. So normally we're used to a 3-year statute of limitations on all this income and our expenses we're reporting on our 1040s or our corporate returns. Statute of limitations is 3 years. Even if it's a pass-through, it's still going to be based on the return, unless it's a TEFRA or now a BBA type partnership return. Might have different statutes than the partners or flow-through shareholders. But these information return penalties forms have carry different statutes with them. That's because they're often coming from a different code section than what we think of as the Internal Revenue Code is Title 26. But a lot of these come from Title 31, especially the FBAR portion, which, as Jared mentioned, was enacted a long time ago, but changed since. So they have a different area that they come from. But the authority to implement the penalties and confirm filings has been delegated to the IRS through a delegation order. We won't go through that. But what people need to know is that, as Jared mentioned, there's a change dates with the FBAR. It used to be June 30th, now it's April 15th, and now you get an extension, but you still have a 6-year statute of limitations. So that the IRS gets an additional amount of time with the FBAR, which is not part of your tax return, it's filed separately. So if you don't file it, there's still an unlimited statute, but even if you file it, it has a 6-year statute of limitations for the IRS to determine if it was done correctly or withheld information. And other forms like the 3520, which was the one that Jared mentioned about reporting inheritance from a foreign individual or trust, you have to file that form. If you don't, if you have 100,000 more, I believe it is, Jared, that you received a gift or inheritance. And then there's the 3520A. I'm not sure what the limit is there, but you in filing that, of course, if you don't file it, it has an unlimited statute. So sometimes if you have to be, the requirements for filing are important, but also remember that if it's not filed, the statute doesn't start running, just like any other form. The one, though, that probably the people get hit by the most, right, Jared, is the 5471.
Yeah.
Because what they don't realize is that the way that's looped together under 6501C8, the statute is 3 years from the date the information is furnished. So if the information isn't furnished, statute isn't running, and that has been interpreted to include the information reported on your 1040. So it can. Go ahead, Jerry.
I was going to ask you, Ben. I think it has to be the requirement, or the IRS could argue that the information provided has to be substantially completed, the form. So if you file a form that's just like you're just throwing something on there that doesn't make sense, if the IRS argues that it's not substantially completed, then I think they can argue the unlimited statute of limitations on it as well.
Right. They can evaluate the credibility of the information, whether it was it substantial enough to result in a filing of return. Similar to like if someone put zeros on a 1040, courts have interpreted that as not a return in certain cases, or if they've altered the return, things like that. But the most important thing is that this opens up your whole return, right, Jared? It's something that a lot of people don't know. Then there's also the provision that gives a 6-year statute if you omit gross income amounts that belonged on your subpart F, right? of your return, which there's a 6-year statute for that. So how does this work? So Jared had mentioned that 2004, the penalties were kind of raised in earnest, but it wasn't until really 2006, at least in my history, at least that's when I started working for the IRS and saw most of these penalties being sought for compliance. And then there were teams and technical advisors created within international, which at the time, was a different part of the IRS and has moved around a little bit, but they had created, a plan of how these were to be audited and tracked. What's interesting about this is because, especially we'll focus here on the FBAR since it's the most common, has strange audit provisions. So the IRS had tripped up a few times, so they've changed their procedures. So one thing they're required to do, since these are different parts, like your income tax comes from Title 26, but the FBAR comes from Title 31, there's different procedures that the IRS needs to follow, and one you'd always need to check is that they've been delegated the ability to look at FBARs, but they have to get what's called a related statute memorandum, which sounds like a statute extension form or something. But what this is first, before someone can ask you questions about the FBAR or start say they have an income tax investigation going on, which they're perfectly capable of doing, but they see evidence of potential need for an FBAR and don't see that it was filed. Before asking for information from the taxpayer, they're supposed to obtain this memorandum, which is essentially they have to obtain basic information that they can without talking to the taxpayer, and then run it by their manager. Then their manager needs to get it signed by the territory manager, who both need to agree that it's indicating that they have it's a failure to comply with the foreign reporting requirements. So then after that, they can begin the audit in earnest. So it's one thing, if they don't do that, they're precluded from using information gathered in the IRS audit for income tax on the FBAR side. And the reason why that is because they have disclosure provisions preventing the crossing over of information in certain situations. It seems silly, but it is a rule, and so you should check to see if the IRS follows that.
Ben, where is the IRS gathering their information on foreign assets or like foreign bank accounts?
Well, I was involved in the offshore credit card program, and so we had obtained numerous amounts of information from what we call John Doe summonses, where we actually went to banks that had branches in the United States but were foreign and obtained information and then investigated further. So it was oftentimes directly from the banks through those actions. Sometimes it was through a promoter, but this FBARs, I think, it's mostly just becomes. There's also this, along with the penalties, there was a whole bunch of requirements for banks and financial service institutions to report information, which has helped the IRS gather that.
Yeah, and that's what I just want to bring up too, is that I talk to people on a regular basis that provide a letter from their foreign financial institution saying, we've identified you as a U.S. person and we're required to disclose your bank information to the U.S. government. If you haven't already disclosed this to the U.S. government, then you should talk to a U.S. tax provider. And it gets a lot of people nervous, but that's kind of what's happening as a result of FATCA. So
yeah, and that was not just FATCA, well, part of FATCA, but targeted those banks and those summonses. A lot of them resulted in settlements where they would agree to send those soft letters, we call them.
Yeah.
But so that is an ongoing, was a lot of banks fought it at first, but I think it's pretty much well accepted now. So once the agent has that process done and they can now start auditing the FBAR situation, they'll ask questions, and they have a whole audit guide of questions they'll ask, and a lot of them relate to willful versus non-willful, which we'll discuss later. But they're trying to obtain the information to confirm that there was a filing requirement, and then whether or not and what penalty applies, because penalties can be greater or lower because of willfulness, and we'll talk about that. But they can also just give you a warning letter for FBARs, and I think though the agents tend to not do that as often, because once they've determined that there was a compliance requirement, even if they get you to file them or clean it up, it's just you fit, because the FBAR penalty is $10,000 even if you're non-willful. So they just want to first, they don't just give you letters so often because they want you to have a reasonable cause argument. So the IRS can pursue criminal investigation and prosecution depending on willfulness and the egregious acts of the taxpayer. We'll go over willfulness and other aspects of that. That's kind of the legal fights that are going on today. So here are the forms that Jared went over, and this is in kind of the penalties that extend depending on the form and what happened with the form, what was required. And you'll notice that the FBAR, if you're non-willful, it's a $10,000 per each non-willful failure to file. So that's each form. So that can be significant. Now again, this could be a $10,001 account, right, Jared?
Yeah, it could.
So that could be a $10,000 penalty on a $10,001 account, and it could be year after year. And let's say the balance didn't change.
To the point where they can wipe out your entire account balances, right? In penalties.
And if you're willful, it's the greater of 100,000 or 50% of the balance in the account. So, and there's potential criminal sanctions. The 8938, which, as Jared mentioned, is similar. It's the sister form because it's asking for financial information about financial assets, right, Jared?
Yeah.
One is filed with the 1040 and one and the FBAR is on its own, but it also has a $10,000 penalty. And then if they send you notice and you continue not to file, then they can do another $10,000 penalty for each 30-day period up to $50,000. The 3520, that's the one that was when you receive inheritance from a foreign person or trust, it's greater of 10,000 or 35% of the gross value of distributions, or 5% of the gross value of foreign trust. That's kind of related to how the gifts are given, right, Jared?
Yeah.
Determine that amount.
Yep.
3520A, which I don't see as often, but I believe that's just when it's a foreign trust, right?
Yeah, it's the foreign trust files a return report, like if they have a U.S. beneficiary or a U.S. owner. So the trust doesn't file it, then the owner should file. If the owner is a U.S. person or the beneficiary is a U.S. person, and the trust doesn't file a 3520A, they have the responsibility to file a substitute form to the best of their ability of the 3520A.
Additionally, there's been recent cases that, and this is more for a U.S. trust, but where the trustee can have personal liability for some of these actions for not filing the forms.
Interesting.
So then here's the 8865 is the partnership version, and it's between 10,000 and 100,000. I guess depending on the facts and circumstances, partnerships of themselves have multiple partners, and by definition, and those circumstances, one thing people will remember, if you fail to file a partnership return in the U.S., it's often just a per shareholder per month penalty, and then if it's a small one and the income was reported, then this is for U.S. partnerships, by the way, then that can lessen or allow abatement of the penalties. So that's kind of what this is driving at here, is that partnerships have different circumstances, especially if income was reported. But the 5471, as we mentioned, it has that, very substantial issues if it's not complete or failed to file. It can open the statute on the whole 1040. It also has the 10,000 penalty per filing, and again, the continued failure to file if once the notice is given, get up to that $50,000 penalty plus criminal if it's beyond it's willful. The 8858, that is the disregarded entities, right? Or not? That's the
Yeah, the 8858 is disregarded entity. Yeah.
right. Okay. And then the 8621, as Jared mentioned before, that's the PFIC one.
Yeah.
Doesn't have penalties, but statute of limitations is open.
Yep. Which could open the statute of limitations on the entire return, like you mentioned earlier, too.
Right. Okay, polling question 2. Can the IRS prosecute an individual with criminal charges for failure to file an FBAR?
All right, that second poll is now open.
So just continuing with that, I mean, since this is every form almost has a different issue with the statutes and definitely is treated differently by the IRS. It may seem like the same information oftentimes, right, Jared? But but the IRS definitely kind of goes down a checklist in every audit to figure out if they can stick it to you.
Yeah, they do.
So you have to be very. You can't just assume, oh, well, they'll be nice about it. You have to. Don't make any of those assumptions. This is one area where they work hard against it. And one thing you have to remember is the IRS, these people get a higher grade to work on these types of issues, since it's more takes training and special considerations. So they want to justify their existence. So you got to remember that they want to stick around and want to get paid more.
The other thing to point out on the 8938s, there's additional information that can sometimes be reported on that in comparison to the FBAR. So, and there's different filing thresholds. I already mentioned that, but there are differences in the form, but they're pretty much the same. Most of the things are the same.
So almost everybody picked yes. There was a few rebels that picked no, probably on purpose.
How do we minimize the penalties on these forms? And I've had many people come to me each year asking questions like, if I've never been reporting these foreign assets, how do I come clean? How do if I start filing now, will the IRS penalize me for other years that I did not file? And are these penalties going to be very draconian, like we talked about with the FBAR? They have the potential, like if you have 5 foreign bank accounts that have never been reported for the past 20 or 30 years, that could be a 10,000. If you're non-willful, that could be a $10,000 penalty for each of the 5 accounts. So $50,000 penalty a year over that. Did I say 30 years that those accounts existed? And so technically that's what the IRS could do, the point where it wipes out the entire balance in the account plus some. And that's really the way that the code is. And so that's what I get a lot of concerns from people is well, is that what they're going to do to me if all of a sudden I start filing these FBARs going forward? And very hopeless. The IRS they're encouraging people right now. They realize there's lots of people out there that have been non-compliant, and they want people to come clean that haven't been, and not just say, well, I don't want to, I'll just deal with the ramifications, and if that's what they're going to do to me, so I'm not going to do anything at all. That's not what the IRS wants. So what they've done is they've kind of extended an olive leaf out for taxpayers, and they've created some amnesty type programs for people to come clean, minimizing those draconian type penalties for people that want to come clean. So that's what we're going to kind of talk about today. And on this screen, you can see the various different amnesty type programs that are out there. The top 4 are the amnesty programs. There's also procedures through IRS examinations and appeals and criminal cases that these things can be sorted out in. But we're going to talk mostly about these, about each of these programs. All right, so next slide. So who can participate in these programs, and this is kind of where we're going to talk about. Before we dive into the specifics of each of the programs, we'll discuss in general who can participate in these programs. And that you can read on this slide that all U.S. taxpayers who are required to file U.S. return and disclose foreign financial assets or file other foreign disclosures but fail to do so are eligible to participate. So that definition kind of brings up, well, what is a U.S. taxpayer? And this is what Ben and I were talking about earlier. A U.S. person or U.S. taxpayer is defined by the IRS as being A, a citizen of the U.S., B, a green card holder, okay, or basically a U.S. resident. And you're a U.S. resident by either becoming a tax resident of the U.S. or by having a green card. So how do you meet the substantial presence test or tax residency test? How you become a tax resident is defined under what they call the substantial presence test. And in general, the way that you look at the substantial presence test is you look at, one, did you spend at least 31 days in the US in the current year? If you did, then you kind of go on to the next step. Did you have 183 days in the US during a 3-year period? And the way that they calculate this 3-year period is they look at your US days 100% in the current year. So let's say you're trying to figure out for 2019, if you're a US person, and you've been in the US in 2019 well over 31 days. So then what you would do is you would say, well, in 2019, you take 100% of the US days, and it doesn't need to be working days. It could be for vacations or anything. And it could be a partial day, would constitute a US day. So then you go back to 2018 and you take 1/3 of your US days in 18. And then you go back to 2017 and take 1/6 of your days in that second preceding year. And if the sum of 100% in 19, 1/3 in 18, 1/6 in 17 all add up to 183 days, you are a tax resident of the US, and you would be a resident, and you'd be eligible to participate in these programs and have filing requirements to report these assets, or these forms, I should say. The other thing is US entities in general. I put OVDP on here because Offshore Voluntary Disclosure Program is what OVDP stands for. It's we're going to go over that one's closed, and we'll talk about it. But that's when people hear and talk about delinquent filings, everyone thinks of OVDP. And when they heard that was closed, I had a lot of people who come to me and they'll say, well, I heard the amnesty programs have been closed, and that's not true. The OVDP program of the amnesty programs has been closed. How that relates to entities is the OVDP did allow entities. The other amnesty programs is generally for individuals. Estates of individual taxpayers are also eligible to participate. Let's go on to the next slide here. So a really quick discussion or slide on this one is this program has been closed, and it closed on September 28th of 2018. There are still people in the program because it's a formal program. You had to ask the IRS to be allowed into the program. And there are still people that are trying to basically they're being reviewed by the IRS and working out, their facts and circumstances. So there's still people in there, but you can't get in there anymore. And so we're not going to spend any more time on this program anymore. But just because you heard that this closed in 2018 doesn't mean there aren't any other amnesty programs available for people that have delinquent international informational reporting requirements. There are other programs that we're going to talk about now. So the first is, and this is, terminology is becoming more and more commonplace now. People are starting to hear more about this as streamline programs. There's actually 2 streamline programs. One, and the first is we're going to talk about, is the foreign program, and this is the most appealing that's out there. It's designed to accommodate low-risk, non-compliant taxpayers that are willing to certify that they're non-willful in their failure to file these international informational forms and disclose their foreign assets. Another point is it's an informal process. You don't have to ask the IRS to be allowed. You just file the forms, and they're not going to tell you that there's closure to it. You have to wait for statute of limitations to pass. And so you really don't get any closure saying, yeah, we received it, you're fine, you're done. So anyway, the appealing part of this foreign program is that there's a 0% penalty for when you enter into this program. So this that raises the question, well, what is a foreign how are you defined as a streamlined foreign versus the other streamlined program, which is domestic? Streamlined foreign is you have to meet the physical presence test for the foreign earned income exclusion. So if you are a person that lives outside the US and you don't spend more than 35 days in the US during any 12-month period, then you've met the foreign aspect, and you have to meet it over that 3-year, one of the 3 years that you're filing the streamlined filing for. So if you meet that foreign test, the physical presence test over one of those 3 years, then you qualify for this. You can come clean and not have to pay any amnesty penalty at all. If there's tax due on a tax return that you're filing, you'd have to pay that, but there's no penalty. And the one thing about these streamlines is there's no protection against criminal prosecution. The IRS you're certifying that you're non-willful, but they can always come back and to you on that. We'll talk a little bit about, Ben will talk about willful and non-willful in just a minute. So the filing program would require you to file 3 years worth of delinquent tax returns, original returns or amended returns. And it requires you to file up to 6 years of delinquent FBARs, delinquent or amended, which is different than the next program, which is the domestic program. The domestic, you had to have filed an original return in order to be admitted into this program. But you still file the 3 years and 6 years worth of returns. But if you don't meet the foreign, then you fall and you filed prior year returns, and you kind of just automatically file into this domestic program, which carries with it a 5% penalty. How is that penalty calculated? They take your total assets over that 6-year period that you're filing delinquent FBARs for. The year where your unreported assets peak, they take a one-time, let's say that over that 6-year period, one of the years, the maximum value of all your foreign accounts peaked at $100,000. They would take a one-time 5% penalty on that $100,000 in lieu of all those FBAR penalties and other penalties related to the other forms. So the IRS thinks that they're being very generous. It seems pretty harsh, but it is generous compared to the OVDP program that was out there before, because the OVDP penalty was 27.5% penalty. The streamline is now, it's for non-willful people, but it's just a 5% penalty. So those are kind of the differences between the two programs, the streamline, and these are really popular right now. All right, so this brings us to another polling question, which is, what is the streamline penalty under the streamlined foreign procedures? 0%, 5%, 27.5%, or none of the above?
The point being that those people that are foreign would have less knowledge of U.S. filing requirements. So
exactly.
Much lower.
That's why they're being more generous to them. The foreign, they have a 0%, because they live outside the U.S. They're not expected to know all the rules and laws that someone that lives here in the U.S. should know. So that's why there's a 0% versus 5%. They're being a little bit more generous. There are people out there, believe it or not, that can be accidental citizens of the U.S. They were born to a U.S. person. They had no idea that they were they're a citizen, and they're trapped under all these laws.
We run into that all the time.
All the time, yeah. So on the streamline foreign, the answer is actually 0%, which the 0 and 5 came in. The streamline domestic is the 5%. So anyway, well done.
Okay, so
All right.
willfulness. So as you can see, the entry into either of these remaining programs requires that you're agreeing or you're making a statement. A couple different things you state, right, Jared? But one of the main ones is that I'm not willful. So what the heck does that mean? And it's really kind of defined as what non-willfulness is not, right? Sort of bunch of factors that are considered, and the problem we have sometimes, I think, is that when it comes to what we call facts and circumstances kind of analysis, considering all those factors as a whole, the good ones against the bad ones, sometimes the agents just seem to think if the bad ones there's more bad ones than kind of overrule all the good ones, but they all kind of match up. So just a description of some of the factors that explain it. So I think the key, though, is that willful obviously implies it comes from sort of criminal legal issues that they kind of adopted these definitions where, in criminal cases these are used a lot when they're trying to determine what was in the mind of the criminal when they committed the act, right? But in tax it doesn't fit exactly because it's so complicated. How would a professional has to make sure they're getting it all right and check the statutes and the regulations, and an individual would have a hard time knowing that. But the basic thing is, if you're willful, you knew you were supposed to report and disclose your foreign income and assets, but you just decided you weren't going to do it. That's basically what the cases define it as. But here we have kind of a non-willful definition that's kind of the reverse of it, right? It's conduct that is due to negligence, inadvertence, or mistake, or conduct that is a result of good faith understanding of the requirements of the law, which is, typically negligence is a difficult one to justify this. That's why, to us, it becomes more of an aspect of, well, there's willful or non-willful, which is our threshold, but we really want to watch out if it have too many factors on willful, but also kind of where reasonable cause fits into this, because I think the agents interpret it as, well, you can't really be non-willful unless you had reasonable cause, which is often reasonable reliance on an advisor. So, what's useful of the U.S. v. Williams definition is willfulness is a voluntary violation of a known legal duty, which is what I said. Just you knew you had a reporting requirement, but you didn't do it anyway. So let's. Now this is let me go with the factors real quick. So if you're willful, one of the questions is, well, who actually opened this bank account? So if you are the one that opened the bank account, that's going to be a strike against you. If it's something you just received through inheritance or something like that, that's a different story. Whether you're tax non-compliant. So what that typically means is, these are special forms that you're supposed to report the income on. You may not have done the form, but did you actually report the income? So even though you didn't do the right form, did you report it somewhere else on the return? So if you did not do that, that's a willfulness factor. Did not seek advice, or you relied upon the advice of a promoter, like a foreign banker or a financial advisor, or someone else that's unqualified, meaning you would know, the average person should know that this person is not as well informed as another kind of professional, right? Now this can be a very strange one, because this comes down to a lot of times the reasonable cause, which is whether the advisor you talk to is competent, which can mean whole breadth of things. I'll talk about that a little. So violations persist after a notification of FBAR reporting requirements. That's for FBAR willfulness, and that's obviously willful, right? You got to notice that you had problems, but you just kept going. did you disclose this? Did you hide this from the person who prepared your tax return? That's going to be a strike against you. If you didn't tell them about it at all, or actively hid it, that's an example of willfulness. Was there a business reason for the account? So, if there was a business reason, that's going to be a factor in your favor. But if there was no real reason for you to have that money there, then that is going to be strike against you. Such as, like do you have family there, vacation home there, something that supports having it at all. If it's just there to make it harder to find the asset, that's going to be a problem. So on the flip side, if you have these accounts, even if you have these, some of those things are in line for you, if this income is from an illegal source, it can be a strike against you. Or if it's associated or created by someone that was a tax scheme. For instance, the accounts I dealt with a lot with the IRS were the offshore credit card accounts. So people would move money offshore through a credit card system. Actually, they'd bring it back onshore through the credit card. But if you were involved in a scheme like that, that's definitely going to strike against you. But if you, like we said, on the opposite side, if you inherited it, or you just had a signatory authority, you didn't even know what was going on with the account because another relative or someone was really controlling it. Maybe they also had signatory authority, but you were just there just in case. You're tax compliant, meaning you're reporting all of it, and you become fully compliant once you're notified of it, and you relied on somebody. Let's go to the next slide. We're running out of time, I know, but
Oh, there we go.
yeah, so these are some of the things we just discussed. So you can go to the next slide there. So then,
Okay.
and what was kind of back on the other one before we go back to you here is the willful blindness, right? Which is an idea created by that case, that U.S. v. Williams case, which is, well, there's all these factors, but what if really all the facts show that you could have known, you could have figured it out, but you intentionally avoided trying to figure it out. You knew you could have asked a single question to somebody and gotten to the answer, or maybe even in some cases your advisor that you did ask misunderstood something, and if you corrected them, maybe it would have a different answer. That willful blindness is something the courts will now use to try to put you in line as willful.
Are you ready for me to
Go
take
ahead.
over on this slide? Okay. All right. And I know we're running out of time, and we have one last polling question, but really there's two last programs, amnesty programs out there. And one is called the delinquent FBAR filing procedures. They're really simple. A lot of the details are here on the slide, so I'll just kind of summarize here what they are. So if you don't qualify for the streamline filing, meaning you don't have unreported income but you didn't file an FBAR, you report all the income from the foreign financial accounts, but you just failed to file the FBAR. As long as you're not under current audit with the IRS, and you're not under a criminal examination or investigation with the IRS, then you can file under this delinquent FBAR filing procedures, which is really simple. It's nice because there's no penalty associated with it. You just file the delinquent forms and you say that you're filing, you got to e-file them, but you've got to e-file these delinquent forms saying that you're filing under the delinquent FBAR filing procedures. And we've had really good success and never really having many questions from the IRS about this, and they've never been issued any penalties on the cases we've been working on. So really good success with this. And again, we'd recommend that you file up to 6 years, which is the amount of FBAR returns, and that would either be delinquent or amended. Let's say that you found that you didn't disclose one of your foreign financial accounts. Well, that would mean you should go back 6 years and file amended FBARs reporting that additional account under this procedure. If you don't have any unreported income from that account, of course. The next one is again, if you don't qualify for this streamline, some people will actually enter into this program even if they do, because there's no penalty and they feel that they were non-willful and shouldn't be. In cases like that, I'd say, yeah, you better seek legal advice to do that though. Because again, the IRS sees themselves as extending these olive branches out. And if the only reason you're filing under this program instead of streamline domestic is because of the 5% penalty, the IRS may not consider that kindly, and they might just throw all the penalties at you and say, well, you should have filed under the streamline domestic program. So
Maybe
only
have
in
a really
cases,
good reasonable cause argument.
yeah, exactly. So I'd seek legal advice on that, in that area, if that were ever the case. But really where this is really used a lot is like you have someone in the US that never filed a prior year return for some reason, but they have reasonable cause not to have filed the delinquent international forms. Then you can file under this program. There's no penalty, but you attach a reasonable cause statement. Problem with this program is there's not much detail with it. It doesn't tell you how many years to go back and file, so you kind of have to, we recommend it, kind of like the streamline, at least doing 3 years worth of delinquent returns, if not up to 6, or more, So that's kind of an area that the taxpayer will need to decide what their level of risk is on this and make a decision. So these are kind of the programs that are out there. They're out. If you guys have questions, Ben and I are happy to answer any of those questions. This brings us to our last polling question, right at the top of the hour in the nick of time. Can I file under the delinquent FBAR filing procedures if I have already been contacted by the IRS regarding a delinquent FBAR filing? Yes or no?
So just to reiterate, it's important that people analyze their whether they're willful, non-willful, but also their reasonable cause arguments, which can basically help them fit into the right program. And when we're saying there's no criminal protection, that means you could go into the program and they could still pursue you if they decided you had lied to them, essentially. Very rare though.
So the majority said no, which is the correct answer. If you've been contacted by the IRS regarding a delinquent FBAR, it's too late at that point, and they wouldn't allow you into the delinquent FBAR filing procedures. So I think the next is just questions, and we went over a lot of material, and again, there's a lot of material in the slides that you can refer to. Ben and I are here as a resource for you as well. If you have further questions, we would love to talk to you and help you with any questions you have on this. We both have quite a bit of experience in this area and can definitely help you fit and understand what, like Ben was saying, which program you really fit into, because that's probably the most important thing. Any closing comments, Ben?
I just, we didn't get to go too much over what reasonable cause was, and that's typically going to be that you received advice from someone. It could be indirect, but usually it's direct, where you've provided all the documents to them, so if they were competent and analyzed it, they should have explained it to you correctly. They just made an error and told you you didn't have a filing responsibility. Then you can rely on that. You got that advice. So that's just, we didn't go over that definition, so just add that.
All right, we do have one question that came in real quick. Will you be holding a PFIC webinar?
A PFIC webinar, that is I can't remember. I'd have to check with our team to see if we have one scheduled in the upcoming year for the rest of this year. I'm thinking we don't, because I think if we had one, I think I would probably be the one holding it. But I will put that down as a recommendation for this upcoming year, for 2020, that we do a PFIC or see if we can maybe squeeze one in before then possibly.
Awesome. Yes, and I don't recall one being on the calendar, but it's always a good idea. So if you
It
guys
might
do
be
have any more questions, oh, go ahead, Ben.
Oh, I was just going to say it'd be good to combine it with, because the changes affected captive insurance companies or insurance companies that a lot of people use, it might be useful too.
Awesome. All right, well, if you guys do have any more questions, please feel free to reach out to Jared and Ben, and we can get those questions answered for you. Thank you all so much for attending, and thank you to Jared and Ben for hosting. Hope everyone has a great day.